Okay, good morning, everybody. There's still people electronically streaming in, but I think we'll get going because the presentation deck is a little bit longer than usual for those of you who've attended before. So I want to see if I can get through it without having to speed too much. And advanced apologies, I'm struggling a little bit with a flu and cough and cold, so we'll uh, so my voice may sound a little bit croaky relative to normal. Okay, so the focus today very clearly is looking at emerging markets within the context of, sorry, this slide. Okay, within the context of three broad areas that I want to look at. So the first is to take us through, and it really is a moving target, take us through the sort of the Trump tariff tantrum, as I call it, which clearly has not only impacted on emerging markets, but also global growth. And so the first part of the presentation is really just to take you through that, to give you a sense of what have been the early impacts of, um, at least in terms of the models, of the new tariff regime or proposed tariff regime with respect to GDP growth, interest rates, and all the macro fundamentals. I'll also precede that by looking at the actual Trump announcements to try and assess their differentiation across the EM world. Then the second key part of the presentation will actually try and unpack the MSCI, the index itself, right? The MSCI EM index, to try and hopefully give you a slightly different lens, perhaps than you used to, with respect to the composition of the index by country and what I call the EM8, which are probably the core of the countries that you need to focus on if you have any sort of exposure or any interest in the MSCI EM basket. And then from there, work through the company weights. What companies are you buying, the sector weights, and so on. And then the third component is of the presentation, we'll look at one step deeper into the individual countries, the EM8, as I call it, those countries will become clear as we go through the presentation, to give you a sense of some of the country fundamentals in terms of not just things like governance and corruption and so on, but also the growth composition of these countries. And I use this approach called economic complexity analytics to understand that. Okay, so it's quite a full agenda. Let's see how far we get within the 2 hours that we have. So let's try and understand what has happened in the last year. And I mean, literally in the last week also, we've seen events in the Middle East, which would also possibly impact on these global growth projection. So to give you some orientation, these are June 2025 projections, as in just hot off the press, prepared by the World Bank through something called the Global Economic Prospects that they regularly produce twice or three times a year. And this, therefore, is a different and new projection relative to the January ones. So what do they show? Firstly, that you have a decline in global growth rates, right? And I'll show it in the next slide, with global growth now projected to be 2.3% for 2025. So that's that light blue bar. So let's focus on the light blue bars for now. But also for emerging markets, which is where our concentration is, the forecast across the full review period, 25 to 2027, remains below 4%. Note, though, that it is China, though, that's witnessing a decline in growth rates as per the projection. So China's growth rate, and if you recall, China's growth rates are generally in the 6-7%. They've always been there, but suddenly now dipping below 5%. And so over the review period through 2027, the projection is that it will go from 4.5 down to just below 4%. But the reason EMs hold is because the rest of the EM basket, if you like, or the rest of the emerging market world is projected to hold steady. And so you see average growth rates actually accelerating in nearly 60% of emerging markets and developing economies. That's the EMDEs over here. So you've got a broad improvement or holding steady of emerging market growth rates. For example, India is driving a lot of that. Even South Africa at its low levels will see growth rates increasing despite China actually moderating its growth rates over the 3-year period. So that's a really important nuance, right? That we always see it as a China growth engine. Yes, in scale it is, but in terms of growth projections, it's actually the 60% of EMs that are actually going to do really, really well. Advanced economies growth rates still remain fairly tepid, going from 1.2 up to 1.5%. I've put this last bullet here because we're not talking about the US, but it is, of course, the most dominant economy in the world, and therefore what happens to growth rates there does have knock-on effects in all sorts of ways. Look at the change in the GDP growth projection for the US from the January to June projection. So in essence, you see a decline of growth rates from 2.8% in 2024 to a new projection of 1.4%. So just stand on that for a minute. It's effectively a halving of the growth projection, sorry, the growth rate in the US between 2024 and 2025. That is a significant decline, and a lot of that has to do with the announcements around tariffs and the inflationary growth consequences that are projected to come from that. Now, I've compared the January to June estimates constantly, and I thought I'd put them here, right? Because what it shows, these are the forecast revisions. It's a little bit technical from 2020 for 2025 and 2026 across the different regions. And effectively, relative to the January projection for 2025, our world growth projection is now 0.4% lower than it was. So in 6 months, we've clipped off, if you like, a half a percentage point of projected growth for 2025. That is significant. A lot of that, though, is coming from advanced economies. So the hit to the global growth projections are coming disproportionately from advanced economies relative to emerging markets, where even though there is a decline, it is lower relative to global projections. So in an environment where global growth is declining, relative to projections and updated projections literally on a 6-month basis seem to be moving the trajectory downwards. So we've worsened our projections. EMs seem to be holding steady despite China's decline in growth. You have to start thinking a little bit more deeply about the role of tariffs, because that's in essence the new exogenous shock to the world economy. So we ask ourselves, what has changed? Why these downgrades in growth for both China and the US and the world economy, even though EMs are holding steady? What's the exogenous shock? And the exogenous shock is the announcement of much higher tariffs by Trump. So we then go back to our textbooks and ask the question, right? What are the channels? So I just want you to first, before I go through the channels of how tariffs impact on growth and employment and so on, just note the graphic on the left, which is the average effective tariff rate since 1790 for the US. And this dotted line represents what is assumed to be well, at the date of this particular graphic, I know it's changed a lot, where our new tariffs or the proposed US new tariffs for as announced by Trump would end up, right? So somewhere in the 20s, let's call it. But note that this orange line is the highest we've seen effectively since about the early 1900s. So what you have is a seismic shift in protectionism from the world's largest economy. And I think that's a really important sort of historical view to take, that this isn't just sort of, from 3% to 10% and so on. It's on average trying to change the nature and trajectory of global trade through much higher tariffs. And I think that's really important. And it's the largest economy that's doing that. So what do tariffs do? Um, Firstly, they do lower GDP and increase imported inflation, right? Essentially, the landed price, as you know, unlike what I guess the MAGA movement believes, um, it's not the sender country that actually pays the higher price on the imported good as a consequence of tariffs. It's actually the receiving country and their consumers. So effectively, we know this immediately. Higher tariffs are inflationary inducing. So you're going to see higher import tariffs, a higher imported inflation, and as a consequence of that, knock-on effects on consumption, on all sorts of investment choices by firms. Inflation is never ever good for an economy, especially large spikes. So if you look at inflationary expectations in the US, they're now breaching 4.5%, 5%. If you go by the recent Michigan surveys, that would suggest immediately a slightly upward trajectory in terms of potentially interest rates. The consequence is lower growth. And that feeds into the projections you saw earlier. So it's no surprise that with tariffs is the projection, at least in the short run for 2025, we've got the specter of lower growth in the US and higher inflation. There's a possibility of increased consumption of other goods. So that's sort of the Trumpian view of the world, is people will switch away from really expensive Mexican avocados to American substitutes. Doesn't always happen. The big one, the big plank though, in the MAGA movement or in the Trump view of the world is domestic industries then are protected. It's a classic what we call import substitution industrialization strategy, that effectively what happens is that you're forced to now, these goods are really, really expensive, and now you're forced to switch to producing locally. That's and so domestic industries will grow and you'll revive manufacturing in the US. That's the sort of and Trump's sort of protection of steel workers, the golden age of US manufacturing should come back. That's essentially his political economy or his ideological view of or reasoning for higher tariffs. Very unclear in terms of the data. The net effect on employment we've seen the world over, including in South Africa, is extremely uncertain, right? So what'll end up happening is there will be an adjustment and a reallocation of resources potentially to substitute goods. Whether those substitute goods are of a high enough quality or low enough price for consumers to switch to is often unclear. And so, in essence, the rebuilding of a manufacturing base in the US through higher tariffs is probably very likely to fail. And I think this is the standard core view of most mainstream economists in the US. There's a view that with tariffs, you get stronger exchange rates, literally because US dollars are scarcer, right, for import demand. And so the US dollar will appreciate. But as we've seen recently, completely running counter to that is if there are growth concerns around around the US economy, the dollar can weaken. And so those output effects are actually dominating the scarcity effect, if you like. You get massive disruptions, again, what we've seen in global value chains, right? And so China needs to figure out ways in which to reroute its goods so that they don't come, so second country importing starts happening, or you start looking for substitutes in other countries with lower tariffs for the particular input that would make the iPhone, for example, massively disruptive, right? Supply chains cannot be upended so quickly, and the consequence often is a shortage of the good or an increased price of the good that's being imported. There's also the idea that you get increased revenue from import duties, which as a first order outcome is true. So you do get increased revenues because of higher tariffs. That's obvious. The little nuance here, for those of you following the detail on this, is that Trump has made the claim before, and he did this in the first era. And those of you who attended the webinar, I don't know, a couple of years back on my webinar on Trump, is that he claimed in his first term that tariffs could pay for the reduced or the lost revenue given his reduced, his lower taxes, company taxes and individual taxes. So he's extended his tax regime so that so the US tax cuts now become permanent that he instituted, but the revenue from import duties will not pay for the revenue lost as a consequence of lower taxes. And lower taxes do not fully sort of pay for themselves through the GDP channel. And that's sort of a separate debate. So it's very, very clear that the advantage, the revenue advantage promised by import duties do not completely play out. There's, of course, a whole lot of uncertainty, and that's what we've seen in the global economy. Where are tariffs going to land? What is Trump going to do next? And in fact, many of us are sort of trying to figure out, okay, so where are we exactly with respect to the negotiations around tariffs with China and so on? So the uncertainty, particularly for those in the supply chain, particularly for receiving and sender companies in a supply chain for commodity, creates all sorts of negative effects and sort of undue investment and consumption uncertainty for firms and households. So that's sort of your overview, how to start thinking about the channels through which tariffs operate. But let's go to the actual announcement. Some of you would have seen it live, the big sort of posters that Trump put up. What did he essentially do? So I derived this graphic on the left, which was his list, right? This is the original as it came off when the announcements were made. I do not have the updates because the updates are incredibly difficult to pin down, given that everything now is subject to negotiation. What seems very clear, and in fact, it was our own CEO, Magda Biazitska, who made this point, that actually the Trump negotiation strategy is to do this, which is you come out with this extreme or top end demand, right? High end demand, and then you negotiate. So it's sort of it's a particular strategy that he uses, which is to come out very hard and very public, and then you go behind the doors, behind closed doors to actually negotiate. So he's come up with this, what is effectively, and I haven't seen this yet, so just think of it this way, that he's attempted to look at US trading partners as by this list, and he's uh, uh, exited with a average tariff rate of close on 30%, call it 29%, right? That range is from the 10% minimum. So remember, there was a 10% minimum that he put on every single country in the list, and up to, as we know, the highest being China. There was a lot of a lot of concern amongst economists at the time of what we call this crime against economics, because there was no clear logic to the tariff formula that Trump derived, and there still is no logic, and I don't think that pretend there is actually. But what it was an opening salvo. It was an opening bargaining position in terms of trade negotiations at a bilateral level with all countries. So where we are at the moment is all sorts of reprieves and periods of negotiations with different countries. But clearly, as I said, what we ended up with in this announcement was a completely new tariff regime that we probably haven't seen for a century, as per the tariff regime announced by the US. And I think that has fundamentally altered, potentially will alter global trade relations. Depends again, as always with Trump, where one actually lands up. Now, one of the things I thought I'd put in here now, and I'm sort of going to swing back to EMs now a little bit more, is that we often forget that, yes, the US runs a goods deficit with the rest of the world, but the US runs very significant services, trade in services surpluses with the rest of the world, right? So think of services as all the products we know, right? Meta, Amazon, Google, Apple, Netflix, all these services that we consume with where the provider is basically the US, is a really important component of US trade relations. Now, the US or the Trump MAGA logic as I said, it's about US manufacturing. We've been suffering at the hands of foreign countries that export their goods into the US, and they're taking away American jobs, right? It's a classic sort of ISI strategy designed to save the American working class. He doesn't put it that way, but that's essentially what it is. But yet, the American economy has moved on from that. It's no longer a manufacturing-based economy. It's actually a services-dominant economy. And so I argue here that he's looking for the wrong medicine, these tariffs, for a problem that is either not there because the manufacturing base has moved on, or it's too far gone, right? So to sort of try and make the US the factory of the world in the way China is, or China and Japan are, it's just the wrong problem that he's looking at, the wrong challenge. So what about services? Well, this trade in the services trade surplus is no accident. In the Uruguay agreement that the WTO structured, there was something called TRIPS, right? So some of you who work in this area may know this very well. And TRIPS is a very well-known agreement in the Uruguay round of negotiations under the WTO, the trade-related aspects of intellectual property rights. What it did was had a whole series of emerging markets, developing countries commit to enforcing advanced countries, read the US, intellectual property protections in exchange for market access. In exchange for market access. So I will enforce Microsoft Word, Excel, licensing, and a whole series of services related licensing agreements and protect those in country as long as I have free access to the US. That was the TRIPS agreement. And so you see massive revenues being earned by the likes of Apple, Meta, Amazon, and so on. This was the quid pro quo. And as a consequence, US services thrived. US technology, as we know, if you think of the FANG stocks and so on, thrived on the back of this significantly reduced threat of loss of revenue in emerging markets. Question is, if Trump goes down this line, and you're partly seeing it led by the US, will you see greater protection, if you like, or attempts to close off market dominance by by the big tech firms in other countries? So I think that's a really important aspect to the retaliation and the response to Trump's tariffs. So on EMs, the challenge was, and here you can, so I should say in this list here, this list is very deliberate of countries: China, Taiwan, India, South Korea, Brazil, Saudi Arabia, South Africa, and Mexico. These are the EM8 that I will come to later. So they make up the top 8 economies in the MSCI EM. And so they're really important for any areas of focus if you have an interest in the index, if you have an exposure to an index such as the MSCI, these are the countries that are going to be dominant. So, but back to tariffs, it's clear that there's no economic logic to and no baseline that Trump built off, right? Hence the notion that he seems to be negotiating backwards. If you look at the gray bars are the tariffs on US imports imposed by that particular country. So for example, South Africa's average weighted tariff on US imports was about 7.6%. The blue bar is what Trump proposed for every country. And you can see there is no logic, right? So for Trump to move from 7.6% for South Africa to 30%, right? For Mexico to move from 7 to 25. And then, of course, the big one is China goes from 7.5% to 104%. Leads one to believe that there's a lot of political economy, there's guesswork, there may be a pure negotiation strategy to sort of set the bar really high and then you negotiate downwards. There's also, which is often not mentioned, strange anomalies, right? So if you look at Saudi Arabia and Brazil, their Trump rate, which is now the baseline at 10, is actually lower than their current average rates on US imports. So, the notion that there's sort of some clear logic. So they took a multiple of, let's triple every single baseline tariff, or a current average tariff, for each country, and work from there. Is just not true. So uh, hence hence the really sort of uncertain environment that we're in, simply because this is the baseline on which the negotiations are occurring, and even at a cross-country level, the logic is very unclear. So let's talk about impacts for emerging markets. And again, those in the red rectangles are the EM8, or the EM8 that I have here. I'll show you the rest in the next few slides. But what is clear is that there are some countries that are highly trade dependent on the US, and we measure trade dependence here by value of exports relative to GDP. And so what you see here is Mexico, and then, although they're not in our EM basket, Vietnam, Canada in particular are vulnerable, if you like, to the negative economic effects from any trade disruptions with the US. So Mexico, if you look at that data point there, their exports as a share of GDP constitute about 25%. So just purely the returns Mexico gets from its exports purely to the US is a quarter of the economy. That's massive, right? But actually, as it turns out, for other economies, most notably China, this is not a big share of GDP. So even for China, which is right down here, right, um, exports to the US constitute just under 3% of their GDP. So the idea that, there's this massive trade dependence across all countries, particularly EMs, to to US trade disruption, if you like, is not entirely true. It's not incidental. It's not irrelevant, but clearly is heterogeneous across countries. So what about our EM8? Well, let's take trade balance and exports to the US as a percentage of GDP, right? So um, exports to the US as a percentage of GDP are all these red diamonds. And you'll see, let's go to South Africa. Yes, we do not want to lose any trade access to the US, and we want to minimize the loss through our trade negotiations and so on. But, get the number sort of locked in that South Africa's trade with the US constitutes about 3.6% of GDP, right? So this is very different to, say, even Taiwan, where it's 15%, or even South Korea, where it's 7%. So the notion that you've got very high levels of dependence across the EM8 with respect to exports as a share of GDP is just data-wise not true. As we said, even China, even though the trade balance, right, um, falls in the favor of EMs, which is what Trump's trying to resolve. So these EMs, like China, are running massive trade surpluses with respect to trade with the US, whereas the US runs a trade deficit. So the positives would indicate trade surpluses. And when Trump sees these things, he gets angry. He doesn't want to see these positives because it means they're getting more money than us. I mean, that's a sort of simplistic way of looking at it. Even our trade balance with the US is fairly, our trade surplus with the US is fairly small. I would look at this and I'd say services are dominant here, right? And so the extent to which the US may end up losing much more in the long run, market access to services is something that you need to keep in mind. So one of the things we want to think about with respect to tariffs in the EM world is the extent to which they may be having an impact on inflation in emerging markets, right? So we know the inflationary impact on the US because higher prices for consumers and the knock-on effect and so on. But in EMs, the interesting first order effect could be deflation, because what you first see is the demand for these exports is dampened. Companies then stockpile excess inventories. And in fact, you're already seeing it in China as companies now see that their goods with higher tariffs are no longer as competitive. And then now they're looking for alternative markets, or even trying to offload products that would have gone to the US to to their own domestic markets. And so these excess inventories actually induce deflation. And you are beginning to see some evidence of deflation with projections in models suggesting, such as the one on the left, that EM CPIs on average may start moderating and in fact decline significantly from 4.5%, say for 2024, to about 3.4% in this EM universe. And that's also true if you exclude China. So to some extent, what you've got is the notion that deflation may accelerate in EM countries that are sitting with excess inventories as a consequence of tariff and protectionism in the US. I think that's on average, just my own reading of it is that's a plausible outcome, but I think there's so many other dynamics within country inflation. If you think of weather shocks, if you think of oil prices that we've just seen now, that I wouldn't take that as a one-to-one relationship, that because of tariffs, everywhere and always you're going to see deflation in all of the EM8s. I think it's a little bit more complex than that, but I think certainly the notion that you've got excess goods that you can't sell to market may see certain price points becoming lower for certain EMs. Okay, and what about equity? So this goes back to this evidence here goes back to is prior to the tariff announcements, but I think they would be reinforced, and in fact would continue to be true post the tariff announcements by Trump. So these are, as you can see, comparing S&P 500 to the MSCI World ex-US, and then the MSCI EM, which is our interest, and looking at the PE ratios. The X's, right, would be the Z score, and so that's the weighted average, right, relative to the mean. So any X below the circle, right, would indicate an undervalued market. And so what this one particular analytical view, and I'm sort of partly at least interested in it, I don't think it's completely wrong, is that emerging market equity valuations are looking more attractive than they used to, right? So you're seeing quite a few EM equity markets, the individual equity markets, trading at a much larger discount than they did, say, a decade ago, right? And for me, that's an interesting starting point for thinking about, are we seeing a switching point in valuations of the S&P 500 relative to the EM universe? And I'll come back to that in the next 2 or 3 slides. So the one question is, does this value gap still hold post the tariffs? I think if anything, it's probably intensified post the tariffs, because US growth is struggling and the S&P 500 is under pressure. EMs may see market opportunities, but then they're also coupled with US growth. So it can go both ways, but I think it's an interesting thesis that you've got an undervaluation in some EM equities. So this is the detail of it. So where the Z score is negative, that means it's undervalued, and you begin to see some of the logic, right? So even though Brazil, for example, so if I run through all of these, Brazil is 1 standard deviation below the PE average, which means it's undervalued, but there's an improvement in the fiscal position, and that may be a potential catalyst for higher re-rating. There's a view that Mexico's new president is actually market sensitive and market friendly, and so perhaps those sort of governance challenges they instituted in the past will be overcome by the new president. We know in South Africa there's a positive view about the GNU, and so that may be driving the sort of upward trend in South African markets. South Korea, again, trading well below its average valuations. Investors may want to enter. The argument is, right, again, this is not investment advice, I should be very, very clear. And they may be, very importantly, a beneficiary of the sort of US and other countries move away from China. So South Korea may be a beneficiary there. China is, of course, the big changer here, right? China is very, very dominant. And the People's Bank of China allowing non-financial corporations to borrow capital, right? That is likely to support growth. That's likely to be a real counter to any kind of trade war. And so you may see significant upside in Chinese markets, also viewed to be currently undervalued by this data. And I'll come back to this in terms of longer run views of the S&P 500 versus the MSCI EM. So, but if you are in the MSCI EM, what are you actually um, buying, right? I mean, I think that's a really important question. And where does your exposure lie? And so what I thought I'd do is come at it slightly differently and start with saying, okay, which countries are you invested in, right? Because that does matter. And if you take this graphic on the left, which I derived, right, is that essentially, and these are my top 8 that I referred to, right? China, Taiwan, India, Korea, Brazil, Saudi Arabia, South Africa, and Mexico constitute 90% of the index, right? So when you weight companies and you allocate companies by country and you take the entire list of companies, 90% of your exposure at the company level, and I'll show you companies later, um, gives you exposure to 8 countries. So to some extent, you should be trying to at least keep a passing interest in these 8 countries, right? If that's your exposure, in particular China and Taiwan and India. And so just to be clear on the index, it's not weighted by country, right? But by market cap of companies. So I've just sort of backed out the country exposure. And there are limits. So companies must have a market cap greater than, you can see that, greater than 1.2 billion. And then there's also a minimum free float that companies need to adhere to. That's why certain companies' values like Aramco in Saudi Arabia are reduced because of not having a large enough free float. But let's go one. So to be clear, 90% of your country exposure in the MSCI EM is in 8 countries. But what is that? That's 50% is in China and Taiwan, right? 30% in China alone. So keep that in mind when you're thinking about exposure. What about sectors? So am I exposed to any particular sectors disproportionately? Well, the answer is yes, right? And a lot of this, though, is just a growth dynamic of the world economy. I think it reflects what's happened in the world economy, namely that information technology companies, financials, and consumer discretionary, right, dominate the sector exposure. So in essence, you're getting close to 50% of your exposure in 2 sectors, IT and financials, right? We'll go through some of the country details, but that for me also reflects 2 big changes. I don't say this here in the slide, but there are 2 big global shifts, if you like, that you've seen in the last 2-3 decades. One is the rise of technology, information technology, ICTs, and the ecosystem of sectors around ICTs, namely banking, insurance. So financial services and technology have dominated the growth story of the global economy over the last 2 decades. So that's the first thing. The second, of course, is the rise of China and India, behind which lies consumers that have become middle class, consumers that have become that have positive disposable income. That has led to the rise of consumption across a range of consumer discretionary items. And I think those 2 big global shifts partly explain what you see in the top 4 sector exposures. So just keep that in mind because I think that's likely to be an engine of growth going forward, particularly in the EM world. China is dominant. So China owns the largest share of both sectors. So China is 43% of your IT exposure and 26% of your 43% of your financial exposure and 26% of your IT exposure. India is the second highest, accounts for the second highest share of financial shares, and we'll get to the actual companies, but it's banks that are important. And Taiwan, of course, TSMC is dominant, is the second most dominant in IT. So if you want to sort of start getting a size and shape, you can say it's a China, India, Taiwan story in terms of country exposure across three big sectors. Notice that it tapers off quite heavily beyond the top two sectors. So it's very left tail dominant. You'll see that you've got everything from from materials right through to real estate. They don't even breach 5% of the index. So there's a little bit complicated, but I've gone through each of the EM8. So I've gone through the 8 countries. So China, Taiwan, India, Korea, and so on, Brazil, South Africa. Saudi Arabia is SA, ZA is South Africa. Now ask, okay, so in each country, which sectors are dominant? And so you begin to get the flavor of country dominance, and also, if you like, even at the country level, country risk, right? Taiwan is a really good example, right? Taiwan is essentially a TSMC play, right? So that's the dominant information technology and a little bit of media tech. Semiconductors is what Taiwan is essentially about. Interestingly, for China, there's a little bit more diversity. So they've got consumer discretionary, which is Alibaba, I believe, communication services at 21%, and then financial, right? So you can see there's a little bit more dispersion in China's exposure across different sectors. South Africa, it's financial, so it's obviously of interest to us. So that's the pink bar is, and that's a lot of FirstRand, Standard Bank, and so on. So ABSA, those banks are dominant here. Mexico is the only sort of strange one where you've got this outlier of consumer staples that are dominant, that are the most dominant in the country's sector exposure, where the one important other aspect that's maybe useful for those of you that like exposure to property is that real estate is very, very small, both at the country level. So if I just go back, real estate was here, it's 1.5%, so it's the smallest share, and it's true at the country level, except maybe for Brazil and a little bit of Saudi Arabia. But even then, it's not that dominant. So what are you actually buying? So what I like to always do is, okay, tell me about the countries and sectors, but what am I buying? What's in the MSCI EM? Tell me my holdings and what do they look like and which are the countries. So close to 27%, so a quarter, just over a quarter of MSCI EM is in 5 companies, right? So those of you who like to read the financials, those are the 5 companies that are worth following, right? Or just see what's going on. TSMC, Taiwan, right? Tencent, Alibaba, Samsung, and the HDFC Bank in India. You can see that it's, of course, Asia dominant. It's not surprising. But also the idea that a quarter of the index is loaded in 5 companies that are, in essence, consumer discretionary, IT, and financials. So, if you're going through the list and see what's there, you've got Infosys, which is India. The only South African company is Naspers, which is over here, which is effectively a proxy for Tencent as well. Top 10 country distributions. China has 9 companies in this list here. India 4, Taiwan 2, South Korea 2, Brazil 2, and as I said, South Africa has 1. So the 10 largest companies, so if you want to go one step up, if you like, constitute about just over a third of the total index, and their market cap's about 3 billion. So again, just to repeat, of the top 10, it's infotech and consumer discretionary and financials, which are dominant. You have a little bit of energy and communication services finding their way in Tencent and Reliance, but it is a story of consumer discretionary, IT, and financial services, even at the company level. So again, it's one thing to look at companies, but it's also useful to keep an eye on the sort of balance in GDP. So I thought, let me just do some of the sort of country dynamics, and this is where we'll move into sort of things like GDP, interest rates, debt, and so on. Um, so if you are buying into the MSCI EM, those top 8 economies, they constitute 28% of global GDP, right? So that's this figure here, right? How does that compare to the US? Well, you're getting 26% of global GDP if you are looking at the S&P 500. Let's keep it simple, right? So you have the same exposure to global growth, if you like, or global GDP in the MSCI 8, but of course, across a wider range of countries. And if you look at the total EM market, that'll be about 35%. But it is China dominant, right? So of that 28%, China is at 17%, right? And you say, well, what about India? Well, despite having companies like Reliance and so on in the index and quite high up, China's share of GDP, India's share of GDP is only 3%. And a lot of it is to do with the fact that it is a low income country, even though it has a large population. And the rest trail, right? The rest truly trail. So Brazil, Mexico, South Africa, and so on. So a lot of it could be population size as well. But in many ways, what you have is a global economy, as we know, that is China and US dominant, and that shows up in this graphic as well. If you're looking at the EM8 and you're trying to understand current dynamics and growth rates, well, despite India having this low GDP, its GDP growth rates are what's driving the EM universe, at least over the recent period. So India's been growing very fast at about 7%. And in fact, you've seen its dominance grow in composition of the index, right? So you begin to see Indian companies growing their share of the index and their weight in the index. A lot of what India's growth story is about investment in infrastructure, mining, and IT and business services, and as we'll see later, pharmaceuticals as well. But the US is growing, right? So despite this, and even though this has declined dramatically now to 1.4%, and it'll be down here, the US is not a laggard in the same way that Europe is, right? So the extent to which you've got the world's largest economy having the largest consumer population, right? Remember our global consumer class webinar a while back. It's also growing at a healthy rate, right? So it isn't the sort of large dominant economy that's growing below 1%, for example. So just keep that in mind again if you're an S&P 500 MSCI EM comparator universe, if that's your sort of if that's your framework. So a lot of GDP growth in the EM8 is driven by India, by China, by Taiwan, and to some extent Brazil. And just keep in mind that South Korea is beginning to look more and more like a high-income country with these growth rates that are coming down steadily. But GDP per capita, that is my point about large consumer population. GDP per capita matters, right? So you can be growing at 7% like India, right? But can I sell iPhones or let's take a mass consumer product from China, right? Is China looking at India as its market? Well, they look at the bottom graph and they'll find India down here, which is GDP per capita. So it's a poor country, right? And despite having a large population, they are not very well off. There isn't a large consumer class. And so the markets for, let's say, Chinese products in the middle of the income distribution, right, that are things like washing machines or, right, consumables, white goods as they call them, would be these kind of countries, but the US is still very, very dominant, right? So it would be your South Koreas and to some extent Mexico, but it is about the US. And so the US, as a moderately now growing economy with the largest and richest consumer base, right, for China's production base, is essentially the bipolar world that we live in, right? In terms of production and consumption. I mean, I'm simplifying it a lot, but that's what makes the current tariff war very concerning for global growth. Interest rates. Now, key, in fact, to the MSCI EM construction, I actually looked at it in a little bit detail a while back, is the construction, and they do look at macro fundamentals. So you may find economies that are large and growing fast, but if the macro fundamentals, e.g., a Turkey and so on, are worrying, they do get downgraded in the index and can be removed and so on. So not surprisingly, you've got, if you look at inflation here, the average in the EM8 is moderate. It's 2.5%. South Africa's at this one here, it's 3%. I think we have a slightly lower figure at the moment. Only elevated in Mexico and India at the moment. But you'd not see, sort of excessive inflation in any of the EM8, and I think you'd be safe with that in the index construction. So it's not something one needs to worry about too much in terms of country exposure, just by design. Interestingly, China is back to my earlier point about deflation and how tariffs will actually reinforce deflation. Is you are seeing evidence of that in China. I mean, look at that inflation rate. I mean, it's 0.5% and beginning to look like what I call the Japan type concern of sort of liquidity traps and deflation that you had in the 1990s. So, a quick footnote for an advert to come, hopefully at our next webinar, is I'll do a deep dive into Japan, another fascinating story. But inflation fairly stable. Interest rates, again, fairly moderate, although you've got some peaks here. So the Latin Americans and South Africa always struggle with macro fundamentals. We seem to have joined the Latin Americans in terms of our macro concerns. So we do have elevated interest rates compared to the EM average of 6%, the EM8 average. So we're sitting, as you can see there, based on this comparative data, that's 7.7%, but Mexico and Brazil still higher than us. I think it's the kind of high interest environment that one should be concerned about in terms of growth rates and so on. But for the rest of the EM8, fairly moderate interest rates. Now, what about debt? So debt's one thing you do need to worry about, because it is going to eat very, very quickly into growth rates and fiscal decline, and then the ball starts rolling in terms of deterioration in sort of economic fortunes of a country fairly quickly. Sorry, just taking a sip of water. And in the context of debt, what you have in the top figure on the left, just again by comparison, is that big US debt figure. 33 trillion is the number that keeps everybody in the US Congress awake. But notice China's is not low. China's is at 14 trillion, and then the rest trail down. What I like to do, though, is to compare countries. So the bottom graph looks at the share of world debt by country. So then you say, okay, well, if I take global debt, right, and say which countries are dominant, well, it is the US, right? 35% of global debt is accounted for by the US. The total EM8, so the 8 that we're interested in, the 90% of the index, they account for 23% of total global debt. So lower, fine. But I need something a little bit more, right? Because it is the country's size and also, of course, the promise to pay, which is really important. Well, the US share of global GDP is 26%, but its share of global debt is 35%. So to some extent, its debt is overrepresented, right, relative to its size in the world economy. Compare this to China, which has 17% of global GDP and only 15% of global debt. South Africa, I know we would be thinking that, is actually, it looks better. So we 0.36% of global GDP, but only 0.29% of global debt. Now, this is just one metric into thinking about debt and debt repayment and sovereign debt. I mean, it's a far more complicated conversation. But it's super interesting to note that the US's share of global debt is actually higher than its share of global GDP. And I think that's part of the pressure that you're beginning to see in global bond markets. It's not the case with China, and it's not the case with the EM8 in terms of their share of debt relative to share of global GDP. And so we then get into debt to GDP ratios, which is probably better if you're thinking about macro fundamentals in the EM8. So again, those top 8 economies, we ask the question, is there something I should be worried about? Certainly, if you look at the US, we've spoken about this before, that debt to GDP ratio is incredibly high, as for Japan, except there are no concerns there, right? There are no concerns because, as I think I've said this before in this audience, I forget, is that if I bought a mansion and I skipped a payment, I think the bank would get worried. But if Bill Gates bought the same mansion and he skipped a payment, the banks wouldn't be too worried because they'd have a lot of collateral to get a hold of. It's similar to the US, right? There isn't a real massive concern. It's all at the margins about the debt levels and so on. But is that elevated? Is Japan's elevated? Well, we've got those two of the richest economies in the world with the highest savings rates in the world. In Japan, for example, most of that debt in Japan is domestic. I think they can be pressure bought by bondholders onto the US, but in essence, no massive concerns about those elevated debt to GDP ratios. The same in our EM world for China. So if you look at China's, we'd surprisingly high, 84% of GDP, debt to GDP ratio. But given China's massive trade surpluses it runs, growth rates, the nature of the economy, savings levels, there are no concerns by bondholders, right, about China repaying its debt. This is not the case for the other two, China, South Africa and Brazil, right? We've got low growth rates, as does Brazil. There are elevated debt levels relative to our growth rates, relative to our capacity to pay, and therefore, those concerns that we know for South Africa hold are the same for Brazil. Now, interesting comparison in the EM8 world is India. So if you recall, we did some work. There was a webinar on bond markets and debt that I did a while back. I spoke about this great equation R minus G, where R is the interest rate on debt and G is the growth rate. If the growth rate is higher and you get a negative R minus G, right, that's a good thing. The revenues generated from growth are high enough to service your debt, the interest on debt. And so that puts you in a good position, and that's where India is. So even though India's debt to GDP ratio is a really important comparator in the EM world to keep in mind, it's yes, there's very high debt to GDP ratios in India. Well, what's R minus G? Well, I can tell you that R minus G means that India is more than comfortably able to pay its interest on debt from growth, revenues from growth, relative to Brazil and South Africa, because India is growing at 7% and we are growing at 1%. So a mixed bag for debt to GDP ratios, but no concerns in particular for elevated debt levels in China in particular and India. So I thought I'd put this in here because a little bit of a sort of, let's say, a little bit of a populist tinge to it is because we often are so heavily focused on the rand relative to the dollar and movements in exchange rates. And I thought, well, let's just look at valuation rates of the EM8, right? And so there is something that's regularly done by the World Bank called the purchasing power parity based measure of each country's currency against the dollar. Now, it's a far more sophisticated version of the Economist Big Mac Index, but it's the same principle, right? A product that looks exactly the same across all countries, like the Big Mac. What does it cost in that country relative to another? And the difference then gives you an overvaluation and undervaluation rate. The PPP measure does exactly the same, but they don't just use one product, they use multiple products, and it's far more sophisticated and carefully calibrated. What you see is that every single EM is undervalued. And I know all of you, I can't see you, but I know all of you are looking at South Africa, and that's the PPP. The middle column is the PPP rate to the dollar of that particular currency. So the PPP equilibrium exchange rate for South Africa should be about 7 Rand to the dollar. It's, well, based on this latest one, it's 18.31. That gives you an undervaluation rate of about 154%. Now, that doesn't mean that anybody's cheating us or the system's unfair and so on. It reflects a lot of other non-PPP related factors that influence an exchange rate. It could be policy, so deliberate undervaluation of a currency. It could be economic fundamentals like terms of trade, capital flows. It can also be a broader representation of investor confidence, right? You recall the Rand declining dramatically when President Zuma fired the late Pravin Gordhan and Mcebisi Jonas, right? We all recall that. So all sorts of factors will cause exchange rate fluctuations, but on a pure basis of what can my currency buy, the Rand is dramatically undervalued. And so is, to be honest, so are all the other EM8 currencies, with Saudi Arabia in particular and the Indian rupee being the most undervalued by over 300%. So just moving now a little bit more to the sort of demography and last two slides on demography and inequality before I get to the economic complexity stuff, is your EM8 make up close to 50% of the world's population. So of the 8.1 billion, 42% of the world's population at 3.3 billion are in the EM top 8. The two most populous countries, of course, not surprisingly, are China and India. But it's not enough to have a large population, and you can see the scaling down here. It's, as I said previously, it is also a large population being twinned with a consumer base that can actually purchase products. In terms of unemployment rates, of course, we have the highest in the world. There's been a recent debate, it's coming out in signals around whether our unemployment rate's 10% or higher. I disagree that it's 10%. It is what it is. But essentially, apart from South Africa, you've got fairly stable unemployment rates, and then a mixed bag in terms of inequality, with Brazil and South Africa being the most unequal countries in the world. So, and in that EM8 basket as well. So I wanted to turn to the EM8 versus S&P 500 comparison that I alluded to earlier in those equity valuations, right? Now, if you take this data here from 2015, so the last decade, it's a very clear case for both on the 1-year and the 5-year returns for the S&P 500. So 25% returns for on a 1-year basis compared to 8% for the MSCI EM, that's the blue line. Likewise, on the 5-year return, 63% versus 11%, right? So a very clear, you also have higher volatility in the MSCI EM if you look at standard deviations and so on. But you also have average annual growth rates at 35% over this period compared to the S&P 500 over 200%. So, and it's not about the EU and it's not about Japan. It is literally a US driven story. So even if I took the index for the EU and Japan, they wouldn't perform as well. So you do ask the question, is there a turning point? And if the turning point in the US is occurring, are we too negative, the US, given this long run? And I don't have answers, these are just questions, given the long run trajectory. But there is a twist to the story in the next slide. So at the moment, what we can say is if you look at futures, right? So both on the MSCI EM and the S&P 500 futures, they're moving together. So there's a general malaise in the view about the world economy that's impacted on both the EM and let's call it the US universe, right? So there's no decoupling that's observable in this data at least. And you did see decoupling, for example, in the 2024-2025 period, even though both indices pretty much moved in lockstep before that. So is this a broader, let's call it negative view of global contraction across the US and the EM universe? And so one needs to keep that in mind. But I want to show you the following, which is the time period matters, right? And so we all have, they call it confirmatory bias, or you can call it, our own sort of reinforcements of what we believe about the world economy. Is I thought, okay, well, let me just be clear. I gave you this data point, which was 2015, so it's a decade, right? But then I said to myself, well, what if I went further back? So what if I looked at the period let's take this graphic on the left. What if I went 2001 to 2023? So if I look at the period, that's the yellow bars, and I look at equity market returns, 2001 to 2023, emerging markets grew at 7.6%, and look at the US. It's only 7.8%. So suddenly, and then if you look at the graphic at the bottom here, which is the MSCI EM against the S&P 500, but starting in 2005, right? It's a different picture until you get to 2013. So the jaws you see here is this picture. So to take you back, is this picture, right, that I've put in large here, which seems like it's a one-way bet, but historically it's less clear, right? So this is not like a punt for EMs and so on. This is just to say, the markets move in wonderfully mysterious ways, right? So if you go back, take a time period that I've given you here, it's not quite clear where one should be, right? And so the question then is, based on valuations, based on the S&P 500, are you going to see a moderating of performance and a narrowing of the gap between, say, EMs and the S&P 500? I don't have answers. It's not investment advice. This is just purely to think about what's going on in the EM universe relative to the global, relative to the US economy. And a lot of, let's call it the orange line, the S&P 500 from over the last decade has been the Magnificent Seven. So is it this IT revolution that we are going to go and see? So here's the counter view, but it's not over, right? The fourth industrial revolution, together with the AI revolution that we're on the cusp of, is being led by the Magnificent Seven. And so we're going to kick on. And in fact, this gap will remain, right? And so we are overstating the case for EMs and understating the case for the S&P 500. Those are the kinds of debates you want to be thinking about. But I thought this graphic was really useful in terms of challenging our, let's call it our possible bias that the only positive bet in equity markets was the S&P 500. So I want to take you through what I call a slightly different avenue now, which is to look at the EM8 based on economic structure, based on economic complexity, based on what these economies look like. And this will be the final section, and actually we're doing really well for time. So I'm okay. Quickly on what economic complexity is, for those of you who don't know, the favorite story I like to tell is a guy called Robert Cheeseborough, who found that the residue from oil in the oil fields in the 1800s, I believe, run by a US oil company, Standard & Poor in the US, the residue from the oil produced was used by oil workers to put onto wounds that they had on their cuts and wounds that they had on their hands. And he was very confused or very intrigued by why the residue from oil was being used for medicinal purposes. So, of course, Robert Cheeseborough, being a chemist, figured out that there must be a chemical compound that had a healing component. And he did figure this out, that oil and the residue from oil can be used with a few chemical processes, can be used to produce petroleum jelly. Petroleum jelly is what we know as Vaseline, right? And so what happened was the building of economic complexity from one product to a nearby product. What Robert Cheeseburger does is he becomes a very rich man by bottling Vaseline, mass producing it, and selling it not only to the US but to the rest of the world. And in the 1800s, the US became the largest producer and exporter of Vaseline in the world. What happened industrially, what happened in terms of economic complexity, is that the US at that time, through Robert Cheeseborough, had the capability to move from one product, oil, to a nearby product, petroleum jelly, and export it and build complexity because he set up manufacturing processes, he set up a manufacturing plant, he employed a large number of people, and so on and so forth. It's another way of thinking about it is moving up the value chain, but you can only move up the value chain if you move into nearby products. And so the idea of building capabilities and implicit knowledge in the production of goods leads through, right, adjacent products or products nearby to this notion of increased complexity. And so you can move from Vaseline. It's possible that Robert Cheeseburger realized there was something else in Vaseline that he could use as a chemical compound to produce another pharmaceutical product, and so on and so forth. And so a country becomes complex in that way. And the most complex countries in the world, you can see it here in the graphic, are countries like Switzerland, Singapore, Germany, and so on. And your ECI score, the Economic Complexity Index score, is associated with GDP. So higher levels of GDP, richer economies are more complex economies. This is all work that's been done by Harvard and a few other colleagues in Europe, Cesar Hidalgo and others, who think about economic complexity in this way. So there's a science behind it. But what you essentially see is economies that are whose GDP goes up will be, in general, highly complex economies. There are some interesting, in the red dots, stories to be told. Saudi Arabia is a very rich economy, as rich as South Korea and Taiwan, which are also in our EM8, but economic complexity score of Saudi Arabia is much, much lower. That's because, as we know, and I'll show you this, Saudi Arabia is oil dependent. That's all it does. It's all it produces, right? Does very little. And so its economic complexity and potentially its future threat to growth is higher relative to more complex economies. You can, for example, so South Africa is a little bit below the complexity mean. So in other words, we could be deindustrializing, and we'll show that a little bit later. Same with Brazil. India is an interesting example where it's a poor country, but highly sophisticated actually for its level of GDP. And so you can see lots of different, China is the same, in Mexico. I want to take you through the product space mappings of these different economies in the next few slides. And what that is to give you a sense of, if you're in this MSCI EM8, maybe you understand a little bit about these economies. And I think one slide can do it and just give you a broad sense of what's going on. So just to orientate you, I'm showing you these for every country, each of the 8, is you've got these clusters of products. So each circle is an export of particular products, so agricultural goods, construction goods, and so on, and they're clusters next to each other. I like to think of apparel as a good example. So blouses, shirts, t-shirts are all in one apparel cluster here where my cursor is. And if it's colored in as opposed to gray, it means that the country is exporting it. And if it's a large circle, it means that it's exporting a lot. And circles that are next to each other would mean that you can move from one circle to the other. So in agricultural goods, you can move from oranges to growing apples, and from apples to making apple juice. And so these will be close to each other. So what you see, this is the product space mapping for China for 1995 and then 2023. So we compare it from one decade to the next, and we ask, okay, what has changed? And so, in essence, what you see is China has seen this textiles. So the collapse in, if you like, clothing in particular, and apparel is very apparent. So less exports in apparel, right, and in textiles, right. And electronics, though, machinery and metals have actually grown, right? So in fact, sorry, this textiles is the wrong way around. It hasn't grown, it's declined. Metals have grown. But in essence, the China story is a significant shift away from simple goods, which is textiles, right? And apparel, to more complex technology-based goods like electronics and machinery. And you all know this, right? We didn't see a Lenovo computer in 1995. We didn't see Chinese cars on the roads in 1995. Now they are here. And it shows, this is why it's a really important ranking. The Economic Complexity Index ranking shows that for China. China was ranked number 32, the 32nd most complex economy in the world in 1995. But by 2012 alone, it was 18, right? And since then, it's moved up even further. It has, as we know, the largest rare earth minerals production, 85% of processing capacity in rare earths and critical minerals is in China, and so on. Taiwan, the the graphic is really instructive, right? From 1995 to 2023. So you see pockets of production, particularly in apparel and textile, and all of that's disappeared. Even in metalworks and machinery, that's all disappeared. And it's essentially become a one product economy, right? TSMC makes up 52% of the MSCI Taiwan index, right? So Taiwan is incredibly vulnerable, in my view, in terms of exposure to um, a single product or a single industry growth engine, literally. So if TSMC sees, which it is already seeing massive competition from other chip producers, Taiwan is vulnerable. Um, and of course, that's apart from the whole China-Taiwan tension. So I'll go through these fairly quickly. So India, it's sort of a story of moderate changes in economic complexity. So the ECI rank sort of stays the same, 55 to 47. And what you see is a growth, and that's in the middle here in particular. Complexity is driven by the minerals cluster, which is essentially around pharmaceuticals and nucleic acids and heterocyclic compounds and so on. So a lot of the DNA replication, mRNA translation, and so on come through the Indian pharmaceutical industry. And not shown here is, of course, the services industry as well. But in essence, hasn't become dramatically complex compared to, say, China. And certainly it looks nothing like Korea, which is now, it's an incredible performance. I mean, the true star in the last 2 decades, 3 decades has been South Korea. Um, it's the fourth most complex economy in the world, and you see that, right? I mean, the electronics, metalworking and machinery, vehicles, chemicals, all of those have come on in increased scale, and you've got increased investment in all these high-tech products. Um, it's the largest producer of one of the sort of most complex products in the world, such as integrated circuits, transmission apparatus for radios, TVs, and so on. And so it's a massive success story in terms of its growth dynamism. Brazil, a little bit like South Africa, but the worst performers, so they make us look good. They've actually seen deindustrialization, and you actually see this here. So you look at this metalworking and machinery cluster in 1995, it disappears, and it disappears to China, essentially. So the entire sort of Brazilian investment in industrial capacity of the 1980s gets destroyed by Chinese competition and their own macro problems. And so it's become a less complex economy. Saudi Arabia, as I said earlier, think of oil. Saudi Arabia does not even, as far as I know, does not even produce its own petroleum jelly, back to my original example. And so what you have is a Saudi Arabia in 1995 that looks exactly the same in 2023. So this is an economy, and I know there's stories about Saudi Arabia opening up and lots of, let's call it, focus on tourism and so on. But thus far, this is an economy structurally that has not changed. And it shows up in the ECI ranking. It's a real sort of reveal, a revelation in terms of the true economic strength of an economy and of a society. And that's not the case for Saudi Arabia, which is essentially minerals, and essentially oil dominant. Some nearby products, but not enough. South Africa, as we know, has deindustrialized as well. So even though we look a little bit better than Brazil, and we do look much better than Saudi Arabia in terms of nodes of production. So if you look at our product space, let's just compare that to Saudi Arabia. That's Saudi Arabia, that's us, far more busy. So we've got a chemicals cluster, we've got minerals, of course, we've got an agriculture processed agriculture, we've got a motor industry, and those have moved along. In relative to other countries, we've actually moved down in our ECI ranking. Now, that's partly because we've had a deindustrialization. Also, other countries have become more complex. Mexico, also a little bit of a mixed bag, although better than South Africa in terms of growing its metalworking machinery and electronics components. But again, that dependence on the US is a challenge. Okay, so the last few slides will just take you through what you have to look at in an EM universe, which perhaps is less true, say, for advanced countries, and that is, what does the governance and business environment look like for the EM8? And so the World Bank produces, and I thought I'd put this here, something called the cost of doing business, and that's the company constraints in a specific country, and it evaluates and measures every aspect of business, right? So it can be things like company registration, credit access, tax and labor laws, or contract enforcement, and so on, some of which can turn, right? So if you think of China, huge concerns around democracy, contract enforcement, and so on in these countries. What's important is the EM8. So in your MSCI EM index, you've got these 8 nations that are above the median of the distribution, so above the median of the doing business score, except for Brazil, right? So if you want to think of where you should sit, what the tails of the distribution look like, the best score for doing business in a country is New Zealand, 86.8, and the worst is Venezuela. And even at that, Brazil's double the Venezuelan score. So one just needs to sort of keep the relative ranking in mind. Where are the countries ranked? So if Brazil is 1, New Zealand is 1, South Korea is 5, Taiwan 15, and so on. South Africa's not that high up. We're at 84, but still above Brazil at 124. Mexico is at number 60. So these are the kinds of rankings that just give you a sense of the difficult spaces involved for companies. It's a busy graph here, second last one, the global governance indicators, but they measure indicators such as rule of law, control of corruption, regulatory quality, government effectiveness, political stability, voice and accountability, all of which actually, interestingly, also impact on perceptions, investor confidence, and then feed into the exchange rate. So this kind of stuff is actually really important, and its movements are really important. So in the EM8, it's clear that Taiwan and South Korea perform at incredibly high percentile scores on most indicators, right? Rule of law, government effectiveness, and so on. India, China, South Africa, Mexico score low in political stability, but then voice and accountability, it's Saudi Arabia and China that are the lowest. Corruption control, we're not the lowest. It's actually Mexico and Brazil. So you can see these improvements over time. And so I just sort of did this in the EM8, the improvements over 2018 to 2023. You see there's been a deterioration in regulatory quality in Mexico and Brazil, and political stability has deteriorated. In this view, in China, South Africa political stability has deteriorated the most. So if you look at this, that's that 45%, and that's a lot to do with the instability in the GNU and the threat of populism, for example, and so on. Political stability, though, has grown in both India and Saudi Arabia. Corruption has improved, so the views on corruption and voice and accountability the same in Taiwan. So, these things move generally, and the trends are important to keep in mind, but this is sort of a measure of the non-economic risk, if you like, in the EM universe that one does need to keep an eye on constantly if you are have an exposure or interest in these economies. So where does that leave us? I mean, I think I've covered a lot of ground, but Trump's tariffs announcements, I think, have completely reset the global economy. They've changed the nature of tariffs and the trade regime for the US, right? Potentially for a very, very long time, for the first time um, in a century, right? Um, and the key relationship to watch here is that between, of course, the US and China and how China responds. The pure GDP tariff elasticity is low, and the trade intensity or the trade GDP ratios when one is looking at US trade in these EMs and in particular the EM8 is actually quite low except for Mexico. Uh, you do need to ask the question. That's the grand question. Is there this great trade decoupling from the US, right? So as EMs pivot away from the US to other economies, because China says, well, hang on, let me rather sell to France or let me sell to Philippines rather than the US. Does this closing up of US borders constitute a decoupling, right, between the US and the rest of the emerging market universe? I mean, that's an interesting thing to watch. I then took you through the EM index. Just to repeat, it's an eight economy construction effectively. China and Taiwan are half of that index. But in your sector exposure, you're getting IT, financials, and consumer discretionary, but a lot of country heterogeneity. 27% of the index is in five Asian companies. So those are the five to watch, the big five, if you like. Um, and you can look at the full list. The top 10 as well are fairly easy to follow. Most of these economies have stable macro conditions on interest rates, on debt, and so on. Population is the one thing to watch, but it's also the size of the consumer market, and that's what locks us into a US-China kind of model in terms of the growth engines. Exchange rates tend to be undervalued for all sorts of reasons. But in essence, let me conclude that despite that you have different levels of complexity in these economies that you have to keep an eye on, the economic fundamentals that drive growth are really important in those last few slides. Also keep in mind that what happened in the last decade, if you look at the MSCI EM relative to the S&P 500, is not necessarily a predictor for the next 10 years. It's an obvious point. And I took you to earlier data which shows that the EM numbers were much better than the S&P 500. It's not to say that that's what will happen, but just keep in mind that we shouldn't have behavioral confirmatory bias influencing our thinking about investments. Okay, thank you very, very much. I'm going to go through some of the questions if there's time. Every year you see an escalating projection. So, generally outer projections tend to be higher, but you'll find for South Africa and most other countries, it's the absolute values that you work off the base. And I understand these macro models are what they are. But the idea that we're going to go from 1 to 3% is not what's been projected, right? I think if you look at the South Africa projections, they're very moderate, right? They do point to I think worryingly low growth rates compared to the Chinas and Indias. So the next question is, what if the net effect of the threat of tariffs is that those who have tariffs in place lower or eliminate them? Wouldn't that be lower prices? Yes. Um, so, so the general point is that protectionism is going to result in higher prices for origin country consumers. So it doesn't matter which country does it. That's true, right? So it's not a US specific argument. So in other words, if China puts up tariffs, prices will go up in China, right? For the US, the transmission mechanism is particularly important because it's a large importer of final consumer manufacturing goods and inputs. And so it's an import intensive economy. And so the tariffs in the US are likely to induce, the idea of elasticity impacts from imports to inflation will be higher in an import-intensive economy like the US relative to an economy that's less import-intensive. That being said, you can get big shocks so in South Africa, our big threat to domestic inflation is oil prices, right? We import oil. So massive increases in the oil price are significantly threatening for domestic inflation. Um, so tariffs in place from 2017 continued under Biden, didn't and inflation didn't take off. Right. So the difference this time is that this is now on top of those additional tariffs, right? And so the big worry is that this is a quantum leap. That is that graphic from 1900s, right? This is a quantum leap in tariffs compared to what we had in the past. Um, and so, but also what happened is that, and I think this is the silver lining, is that Trump landed much lower than where he started in Trump one's tariffs, right? And so the question then is, um, will he land, right? Will he land back to where he started as in the Trump one experience? So even though we elevated, we don't end up at 100% for China, but maybe 40% or 30%. I think the evidence still is, especially if you look at the macro models, that you are going to see higher prices. Um, and Olivia says my Microsoft subscription has gone from 60 Rand to 154 Rand. Well, there you go. I'd need to check, Wayne, how many stocks exactly in MSCI EM Korea exactly. I could get you that number, but I think I gave you um, so this will be distributed, but you had the total in sorry for the rest of the audience having to look through this. So this is so South Korea had two in the top 20, right? Sorry, Wayne says Taiwan. How many stocks in the MS? I need to check that, right? So, but Taiwan, the story is it's TSMC that's very, very dominant, and I think that's the important lesson. 50% of over 50% of market cap in Taiwan. Yes, does cover both Hong Kong and mainland China. Is there not a correlation between US interest rates and that of South Africa? Yes. So I think there's a correlation in the sense that, if you're seeing elevated interest rates on treasury bonds, that makes US treasury bonds more attractive. That means capital flow invested in South African bonds as the differential rises will move to US treasuries. And so that's the extent to which you're going to see that kind of correlation. I don't like to immediately talk about the impact on the CPI because for us, it's everything, as I've said, from weather shocks to oil prices and so on that then impact also on the CPI. Yes. So China, as I said, the devaluation or the undervaluation of the renminbi is actually a lot to do with the China peg in that particular instance. I was just trying to give you a PPP sense, which is the purchasing power of your rand or your renminbi or peso when you travel abroad. That's the key sort of metric. But exactly. So part of the undervaluation could be, as I said, could be exchange controls or just pure policy. How do South African investors hedge against being whipsawed when first world economies bet against EM and retain global? So we are price takers, unfortunately, in in global markets, particularly if you look at the EM as a composite measure of concern. So if something happens in Turkey, suddenly there's an EM response, right? Where we have nothing to do with a military dictatorship in country X or political instability in country Y, but that pulls a lot of investment sentiment away from EMs towards developed countries and so on. Um, Tom says we're in a permanent state of being polarized. Trump is a love or hate, and so on. Uh, How do we understand the economic issue? Sorry, it's a long one from Tom. I think the tariff issue is misunderstood. A company in the US can't compete with a company in China when it's not even labor laws, when it's not even. Okay, so a lot of comments there, but in essence, exactly the point I made is that I don't think, and there was a report yesterday of a local US company that has now filed for bankruptcy. They were trying to make semiconductors. For me, that says it all, right? It's the idea that South African firms can compete with the Chinese in certain products. It's not going to happen, right? And it's not going to happen by fiat. It's not going to happen by tariffs and so on. You may see an enforced buying because of necessity into local products, but eventually the policy becomes too expensive, or it doesn't create the jobs, or companies go bankrupt. So I think at the end of the day, tariffs are not the answer, at least in the extreme sense. Then I wouldn't say never use them, but in the extreme sense that Trump is using them, I think it's problematic. And this is a good question. Do other countries have the consumers to absorb the Chinese production that had an outlet in the US? I think that's part of the decoupling discovery, if you like. So can firms see, particularly Chinese, Korean, Japanese, other firms that have only seen the US as their market, are they going to start exploring other markets perhaps that they haven't? It is a long road, right? You don't sort of suddenly open up markets. But I think that's definitely something to watch, right? Where the emerging markets look for other markets elsewhere. Um, the goods already in the US, yes, so that the tariff hasn't been imposed. So that's why you saw the spike in the US trade deficit, because there was massive importing from companies that are trying to stockpile both on inputs and final goods where they could, because of the threat of future tariffs. Okay. A lot of questions. I can't take all of them, guys. So let's see. How does the war affect the tariffs imposed on emerging markets? That's a big question. At the moment, the transmission channel of impact of the war at the moment is on the oil price. So that's the key to watch. And so for us, it's about oil to inflation. So that's a key factor to watch. I read this morning that Trump said on Truth Social that there's now a truce, right? So maybe the 7-day or 10-day war, whatever it's been, is over. So perhaps there's a bit of normality and we can control for disruption there. It's a great question from Anonymous. What percentage of the revenue of the MSCI World DM index comes from EM countries on a look-through basis? I wouldn't have that answer, but it's a good question. It's definitely worth looking into. If China takes over Taiwan, what happens to TSMC? I think they're in big trouble, right? I think that stock starts collapsing, because I think then China controls the environment that TSMC operates in, including access to the American market. There's all sorts of geopolitical effects that will definitely impact on TSMC stock. So I think it is a huge threat. Yeah. So once the tariff pause ends, Trump is so unpredictable. Everybody says, okay, but he's going to do this next. I mean, he literally bombed um, uh, Iran when the day before he said that he's going to give it 2 weeks. So, there's a 90-day pause. It's supposed to end on the 9th of July, but he could wake up and say, no, I'm extending it. And the pause may mean nothing, because countries are actually busy negotiating. China is still negotiating, South Korea, Mexico is still negotiating. And remember, once if the 90-day pause ends, regulators may not be trumped by the negotiation, excuse the pun, but regulators may not necessarily institute, which takes about 3 months, institute the new tariffs, because negotiations that are going on may take prominence over the actual announcement, if that makes sense. So if he said 120% for China, but there are negotiations going on with China, those negotiations take precedent over the ending of the 90-day pause. So if it sounds like a mess, Louise, it's because it is. It's a very unclear, opaque environment. Yeah, so there's another question about TSMC and China invading Taiwan. That's an outlier threat. I think China's looked at the mess that's been created with Ukraine and Russia. I said this in a previous webinar, and they'd be very, very wary to suddenly enter into Taiwan on that basis. And likewise, what's happening in the Middle East. So incredibly disruptive. They have their own homegrown problems. They're trying to recover growth, fix the housing market. Xi Jinping is probably less focused on Taiwan. I don't think he'll let it go. I think it is part of his core political goal. But I think for now, he's probably going to leave it alone, given what's happened globally. That would be my sense at this moment. Okay. Well, thanks very much, everybody. I hope that was useful. And I believe that the recording will be available, and then we will also distribute copies of the slide deck. But thanks very much, and look forward to seeing you all next time. Bye.